show.
Hi Annette, thanks for having me here. 2025 has started off as a very volatile year. No, lots of things happening on the geopolitics side, the tariffs, and also the interest rate environment that is around. So 2025, we are going to focus largely on getting the basics right. We have a high occupancy, but still one or two of our assets are suboptimally leased. So we will improve the occupancy for those. We are trying to also improve the efficiencies and the rental reversion of our assets. Both these activities are going to improve our top line and therefore our bottom line for distribution to our respective unit holders. Second, we are also looking at divesting some of our assets, be it in business parks, industrial, and more importantly, strategic divestment of the data center portfolio. About 33% we are looking to divest this year. This will enable us to recycle capital into opportunities that are more income yielding, and also at the same time reduce some of the debt burden that we have, and by that improve the bottom line again and improve the distribution to unit holders. So in a summary, it is think about all mechanisms possible to improve the cash flows to our unit holders so that the dividend yields can improve, and that can be an impetus to our unit price. It's like I said, volatile environment. The interest rates are fluctuating. One day it is high, one day it is low, but over the last 2-3 years the interest rate environment has been high, and our journey to make ourselves resilient started quite some time ago. We are looking to onshore as much debt as possible. Historically, by being listed in Singapore, we were able to raise debt at a lower cost, swap it into INR and send it to India. And if you compare that with the interest rate in India, we used to have 150 to 200 basis points differential. That has kind of evaporated over the last 2 years. So since then, we are looking to borrow mostly in India as against in Singapore. It becomes a natural hedge, so currency fluctuations aren't there, and also we get the full tax shield, whereby we are able to reduce the effective taxes that we end up paying, which is a burden on our distributions. So resiliency is by transferring the debt onshore and providing better tax effective shields for our unit holders so that our dividends increase. So this is how we are thinking about it. REITs have been quite resilient in this market turmoil. I mean, REITs have had a negative correlation to the interest rate environment, but notwithstanding that, in the current turmoil, REITs have pretty much played better than all the other asset classes. And the reason is quite simple. I mean, REITs are investments into real assets, and typically these are the underlying contracts are long term with in place escalations, and most of the tenants are good quality tenants. So these are defensive investments, and when the markets are volatile, better to be in defensive portfolios as against non-defensive portfolios. Specifically with respect to CLINT, we are averaging about 94-95% occupancy, and our rental reversions, particularly in the 3 main cities of Bangalore, Chennai, and Hyderabad, is in the high single digits, and our contracts are on the average lease term is about 6.5 years, and we have annual escalations averaging about 4 to 5%. And in times when the world is looking at reducing costs because of all the trade and the tariff war that is happening, India becomes a very attractive destinations for global capability centers to be set up, and for Fortune 500 companies to move a lot of their services to India, especially when their cost structure is going high. So CLINT happens to benefit from all of this, being the only access for Indian assets, but being located in a high governance, much more liquid market, which is in Singapore. So therefore, I would say CLINT is very well placed to leverage on this opportunity. And from a timing perspective, because of what is happening in the last 1 week since the announcement of the tariffs, the markets have been volatile, and the unit price of CLINT is trading at quite a discount, and I'm fairly certain it's not going to last for too long. So if anybody is looking at entering this market, it is right now. You're never going to regret it. If you need to talk about data center, I mean, it's you need to wind your clock back to 2020, 2021 COVID years. We realized during the peak of COVID that business parks at the end of the day have one risk, which is if the employees don't turn up into the office, you are going to be at risk of your tenants terminating their leases. It didn't happen to us. No, we still had our collections, almost 96-97% rental collections, and our average occupancy was still in the 90s. But it gave us a warning signal, and the warning signal was, no, you need to diversify. And the asset class which we found a lot of adjacency was the data center business, because we are already present in industrial parks, which has abundance of power supply, and where you have all the basic infrastructure already readily available, and the potential tenants that use cloud and other enterprise services through co-location are our existing tenants in our business park. So we felt it's a great segue into an asset class which is what is going to be in the future. So we thought we would use this opportunity to diversify into data center, and the going has been great since then, because if you look at India contributes about 20% of the digital content, but data center space availability is only about 3%. If you look at it on a per capita basis of per million customers, India has for every million population, it has only one data center. Now China has 4, Europe has 12, US has 50. So the potential for growth in data center in India is humongous, and we felt we were at the right time at the right place, and why not use that to leverage the opportunity and accrue the benefits for our unit holders. Thank you. Thank you, Anar. Pleasure.